There are starting to be some really attractive dividends on the market today from some really well-known, very stable companies. And so I want to go through 5 that I think investors should be considering in 2024 as we get rising interest rates, as certain stocks starts to drop. A consistent dividend can be a great way to offset some of the market's volatility, generate a little bit of cash flow, and even beat the market if there is potentially a downturn or a bear market on the way. So that's what I'm going to cover today is those 5 stocks. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start this discussion with Verizon. As I'm recording, shares of Verizon are trading for about $40 a share, and the dividend yield is 6.6%. Their dividend has been increasing slowly, but not all that much over the past few years. And the trends are starting to look pretty positive for Verizon. Now, the core business is really strong. People continue to pay their wireless bills. This is obviously more like a utility kind of company. And there's competition in the space, but we're now at more of an oligopoly market where there's 3 major competitors in the US. So while there is going to be pricing pressure, margins are going to be a little bit limited. I think the competition is not going to be nearly as fierce as it was when there was 4 players in the market. So we're starting to see some evidence of that. First thing I'm going to show is the free cash flow from the business. So you can see that free cash flow has been increasing slowly over the past year or so, starting to turn a corner from about $14 billion in free cash flow in 2022, 18.7 in 2023. These are all trailing 12-month numbers. Now, if we take a look at these same numbers, but just look at operating cash flow, capital expenditures, these are going to be the 2 biggest drivers of the business. You can see the major trends are that operating cash flow continues to be consistent. This is what you would expect from a company like Verizon. Not a huge growth company, but you just want that cash to keep coming into the business. So $37 billion or so each year for the last 2 or 3 years. And the big improvement over the past year has been a reduction in capital expenditures. Capital expenditures include not only buying up the spectrum that accounts for the 5G network, but also building out network itself. So Verizon goes through a major investment phase and then goes through a phase where it's going to generate a return on that investment. So we're moving into that phase where they're going to be generating that return. And I think as interest rates rise, the amount of return that all of these companies are going to expect from the capital that they put into the ground is going to increase. And so I think we're going to see both a reduction in CapEx going forward, but also an increase in that operating cash flow as they're able to do price increases and add customers into fixed wireless and things like that. So I think a lot of tailwinds. In the meantime, investors are getting 6.6% dividend yield. So a great stock for investors looking for a solid dividend. The next one I want to go over is in a very different market. Having a rough day today, recording this on Wednesday, but down 5%. That is VICI Properties. VICI Properties owns a lot of the casinos in the US, the land and the actual physical building for companies like Caesars, MGM, $30 billion market cap, and their dividend yield is 5.9%, paid out $1.66 in dividends over the past year. The concern for VICI and the reason that you would have a higher dividend yield like this is a company that borrows a lot of money to acquire real estate assets. And so interest rates are going to take away some of the cash flow that could be paid to investors, to shareholders, because it's going to be need to be paid to either pay off some of that debt or pay interest on that debt. So as debt is refinanced, it's probably going to be refinanced at a higher interest rate. But the thing that I think we need to look at with VICI is this consistency of the tenants that it has. This is not a company that is going to have restaurants as tenants or a hotel that's going to require hotel occupancy to remain high and day rates to remain high. The deals that VICI has with the casino operators entail them paying consistent rent with slow escalations in the future. What's happened, particularly in Las Vegas over the past couple of years, is that revenue has shot up after a lot of those casinos were bought by VICI and the real estate was bought by VICI. That means that their coverage ratios, their ability to pay rent on an ongoing basis, has actually improved over that period of time. Also, their rent should be increasing. Usually have caps on that at 2 to 3%, but that's going to increase their cash flows from the business a little bit over time. So solid dividend yield. There is going to be pressure long-term on cash flows if interest rates remain high, but this is an opportunity for management to be a little bit more conservative with the acquisitions that they're making, maybe pay down a little bit of debt in the future. But as long as that cash flow is coming from your tenants, from the casinos that are operating there, I think this is going to be a very good business to own long term and just collect a dividend. So that's why VICI Properties is the second on my list today. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Third on the list is Brookfield Infrastructure Partners. This is a company that owns a bunch of infrastructure assets all over the world. Current dividend yield is about 5.5%. And you can see not having a great day today. And again, same reason as VICI, interest rates are up. So therefore dividend stocks tend to go down on days like this. But let's look at some of the assets that Brookfield Infrastructure Partners owns. You can see that the Americas amounts for most of their business, 69%, Europe 17%, and Asia Pacific 14%. There are utilities, midstream businesses, so this is going to be things like pipelines, transportation, and data. Pretty evenly distributed, with transportation leading the way at 39% of the business. So this is the kind of infrastructure that you're going to be getting with this company. Utilities, regulated or contracted businesses that earn a return on an asset base. Transportation is rail operators, terminals, export facilities, toll roads, and then intermodal containers. That's the other thing that's part of that transport to business. So that's going to be the biggest driver of the business. Midstream, like I said, natural gas storage and pipelines, liquids processing plants. And then data is going to be things like fiber optic cables, telecom sites. So a lot of different infrastructure assets here. And over the course of the company's history, a nice 15% return for investors. That distribution, $1.53 in 2023. Again, like all the other companies here, are going to be pressured by higher interest rates. But I think the long track record of success for Brookfield Infrastructure Partners is the kind of thing you want to buy, especially with a dividend yield in excess of 5% today. Next up is going to be a company with similar pressures. That's going to be NextEra Energy Partners. And this is one of the reasons that NextEra Energy Partners is down as much as it is over the past year. You can see it's dropped 53% in the past year. Is they do have some debt that needed to be refinanced and basically just some operating questions that needed to be answered by management. A lot of that has been answered, and management continues to say, hey, we're going to continue paying this phenomenal dividend. $3.73 is what they're expecting for distributions per unit in 2024. So at the current share price, that means the dividend yield is 13.1%. That's a really, really high dividend yield, indicates that the market doesn't think that the yield is going to be sustainable, but management continues to say that through 2026, they expect a 5 to 8% annual growth rate with a target of 6%. Probably going to have to adjust some of their finances a little bit. Wouldn't be surprised if the dividend yield starts to come down and they say, hey, we're going to pay less of a dividend because we need to pay down some debt this year or next year. And you give them that flexibility with the high dividend yield. But I just like the consistency of the cash flow coming from the business. This is a business that owns wind assets, solar assets, energy storage assets, long-term contracts to sell that electricity to utilities. And so very consistent cash flows. It's just a matter of where the cash flows are going. When interest rates are going up, more of the cash flows are going to go to debt holders. When interest rates fall, more of the cash flows can be paid out in things like dividends. So right now we're in that rising interest rate environment. That's when stocks go down, but that gives you a nice entry point and a nice yield to get as an investor. The final stock, not too complicated, Whirlpool, dividend yield of 6.3%, PE ratio of under 13. You can see that the business has struggled a little bit over the past couple of years, but now returned to profitability. The dividends paid out, which is this orange line right here, has also been consistent, now $7 per share. So really nice dividend yield. I think a very consistent business. There is going to be volatility depending on the economic environment. Maybe there's a little bit less spending more recently, but this is the kind of company that I think is still going to be around 100 years from now. So buying at a nice valuation in respect to both its net income and its dividend, I think is a great opportunity for investors today. So those are the 5 dividend stocks that I wanted to highlight today: Verizon, VICI Properties, Brookfield Infrastructure Partners, NextEra Energy Partners, and Whirlpool. Which one is your favorite? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.